Hello and welcome to the Andrew Hines Audio Real Estate Podcast. This is the inaugural episode. It is February 14th, 2019. It's Valentine's Day. Hope you have someone special to spend tonight with. And today I'm going to be telling you a little bit about this podcast. This is all things real estate, mainly because for me, real estate's a pretty passionate thing. It's something that's allowed me to have some freedom, got me through some hard times because of the cash flow. And I'm going to be focusing on that in this podcast. So all things that create cash flow. We might even deviate from real estate a little bit from time to time, but that's generally our focus. I'm going to have some great guests coming on. Tell you a little bit about myself for those who don't already know me. I'm a real estate investor. I have been investing since 2011. So I guess in the grand scheme of things, not that long. Bought my first property at 24 years old for cash flow, and I've been doing it ever since. Now, a lot of people run into the same problem, and that's getting more money to buy more properties, getting more bank approvals. We're going to be talking about all those things. How did I overcome those obstacles? And one of the ways that I've managed to grow my portfolio like it's on steroids by doing the BRRRR method. That's the buy, renovate, refinance. Renovate, rent, refinance, and repeat method. I'm not sure where that terminology came from. I never even heard that until 2018, late year. It's probably been around forever and I just wasn't paying attention. But so it's going to be fun. We're going to talk about, different things with different guests. I've, over the years, through a couple of different groups I've been in, I've come across some really inspirational guests, and we're going to have them on the show. This is the first episode, probably not going to be a super long one. I've never done a podcast before, so we'll keep it light, we'll keep it entertaining, and then as the quality and the volume of content increases, we'll keep growing these episodes and we'll keep doing more. So without further ado, let's talk a little bit about the BRRRR method, and then we'll carry on into future episodes with other topics. So starting right off, I'll tell you kind of what got me into it, why I wanted to do it, and then of course what it is. So basically the BRRRR method is when you buy a property and it's kind of like a flip, except you don't flip. That part at the end where you're supposed to sell? No, we don't do that. And even though I have sold some of my properties, I've always sold them as rental properties, meaning that there was a tenant in place, there was cash flow. And that's something that's a lot different from what you might see from other homeowners selling flips on the marketplace. I don't consider myself a flipper. I have definitely sold a few properties over the years, but the things that I'm most proud of are the properties that I've kept. And there's way more than one reason. I mean, for one, if you think about what you get out of keeping a property, one, the market goes up every year. So starting with appreciation. So appreciation, for those of you who don't know what that is, that's just your property going up in value every single year. A lot of markets in the greater Toronto area where I'm from, they've seen appreciation rates in like the 30% range. That is not sustainable, not going to happen every year. But at a bare minimum, on a long term, even in a semi-weak market in our area, 2% would be a minimum. I'd say most markets, you're probably going to expect somewhere from 2 to 5%, maybe 6% in the long run. They go through different stretches, right? It doesn't mean it's a guarantee, but the nice thing is if you've got a property worth $100,000 and it goes up 2% in a year, that's $2,000. So keep that $2,000 in mind. But most people where I'm from, when you're buying a house, a rental property, you put down 20%, which would be $20,000. So if you're $20,000 in and you just got $2,000 in 1 year, just a passive appreciation, just your property going up in value, that's 10% return on investment just from your property going up in value. And we haven't even gotten into cash flow. We haven't gotten to any of that fun stuff yet. Then the other elements, of course, you get cash flow. Some of my properties have seen cash flow, $600 plus per month. And some of them are going to be even more than that in the near future, just from the market changing. So when you sell a property, and I've literally experienced this, I'll be driving down the street and I will see a property that I owned and I'll be like, damn, I wish I still owned that because it's worth $100,000 more than what I sold it for. And thinking back to what I got out of it, I'm like, wow, that wasn't worth it at all. I should have kept it. So I'm always thinking, how do I keep them? Of course, there's that one challenge. What are you doing for a daily basis? What are you doing for daily income? A lot of people work jobs. I don't do that. Fortunately, going down this path has allowed me to make some changes. I do have some things that I do. I do some general contracting. I still have my mortgage license. So I'll do some talking and speaking engagements. But generally speaking, most days are free for me to kind of go about my endeavors. And I run a couple of my own companies now because of that. So where was I? Just talking about the different benefits. So the cash flow is a big one. In a year, you could see, if it's $600 a month, times 10 is 6,000. So 7,200 times 12. If you're 12 months of $600 a month. So that's $7,200 in a year of extra cash. And then on top of that, your mortgage is paying down, which is a little more difficult to equate, but you can basically just go online, find a mortgage calculator, and you could figure out what you'd be paying down. A lot of people just like to use 3% as a rough ballpark, which isn't bad. But when you combine it all together, I like to see a return on equity or return on investment, if you will, of somewhere between 25 and 35% return on investment for just a passive real estate investment. Now, no real estate is truly passive, but it can be made more passive. So this is all, we're getting into that BRRRR method. These are the reasons to keep, right? Because what can you do with your money, otherwise? Where are you ever going to get that kind of return? And that return is just based on, like, my 30% estimate is based on getting maybe 4% annual appreciation, your property going up in value. What about markets where your property is going up in value more? There are many times it happens, and you might just catch the wave, right? Sometimes it might be lean. It might be slow and steady for many, many years. And then finally it takes off. That's the beauty of real estate. You want to be in a position where you own it before it takes off. And so that for me is the driving factor with the BRRRR method. The other thing is if you set up property management, if you can get good trades, and having a few properties helps for this, because once you have a good handful of maintenance people, property managers, rental agents that will help you when things go wrong, you can eventually start to remove yourself from the equation, right? I wouldn't recommend doing that too fast, but this is a model where if you do it down the road, you could be sitting on $10,000 a month in passive net cash flow. And that's money that you could use to travel the world. That's money that I've seen, and I know firsthand people who have quit their jobs and they're now doing whatever it is that they want on a daily basis because their real estate allowed them to do that. So that's why the BRRRR method, and it's why I would recommend for you to do some studying on it. Learn how to do it in your area. So here's some of the fundamentals I'll give you right now. Fundamentals to getting started with it. One, you're going to want to know your market. What can you get something to appraise for? And the beautiful thing when it comes to rental properties is you get to work with something called a cap rate. And a cap rate is basically a rate of return. Appraisers out there, and the appraisers work for banks, and the appraisers are the ones that are going to tell you what your property is worth. A good appraiser knows how much a property is worth based on how much return it makes. And they use something called the cap rate. And you guys can Google this if you're listening, if you're driving right now, maybe, obviously wait until you get home. But if you're basing your valuation on a cap rate, then me as the investor, when I'm going in and I'm doing my numbers from day one before I even own the property, I say, hey, what can I get on that property for rent when I'm done? I can estimate the expenses, and then I can pull out my spreadsheet and I can actually calculate what the property will be worth based on its cash flow. Now, that's not perfect, but it's usually a pretty good indication. And if you run in investor circles or you start networking with investors, which I highly recommend, you start to get to know people that just want a certain cash flow. And there are plenty of people out there that just want a certain cash flow, and they're going to be happy with a certain cash flow. And then you've got your appraisers that know the same thing, cash flow, overall return, your cap rate. And It's okay if you don't get this, but cap rate basically is just your operating income divided by your total investment. Divided by the total cost of the home. So if the home is $100,000 and your operating income is $10,000, then your cap rate is 10%. So operating income is basically just your rents minus, property taxes, insurance, maintenance, management, any utilities that you pay, any snow removal, any landscaping. That's what gets you down to your operating income. And then when you've got that operating income, like I said, just divide it by the total cost of the asset, the house. So $10,000 operating income after all expenses, not your mortgage. You don't consider mortgage with this, but just after your expenses, and then divided by your price. So if it's 10,000 over 100,000, there you go. You get 10%, which is a pretty awesome cap rate. If you can get one at 10%, you're doing well in most markets, but every market's different. So it starts with doing some research, find out do your research on what a cap rate is, figure that out. This is the way I do it. Not everybody will. There are plenty of people out there that just flip houses and sell them to homeowners and list them on the market. I don't like to do that. I find that that's way too much of a variable. It's hard to figure out exactly what you're going to sell something for. So those are just my thoughts as to the best approach for me. And you may be different, you may not be. But if you're planning on selling or doing the BRRRR method, where you buy, you renovate, you rent, you refinance, and you repeat, that's cycling money, right? So the idea is you're going to have to rent. You're going to have to be a landlord. But this pays off in the grand scheme of things. When these properties keep going up in value, there's nothing quite like it to build your net worth, especially with some of the tax benefits that come with that, which I'm not going to get into in this episode. We can talk about that another day. So we talked about knowing how the valuation works. When you understand a cap rate, you understand what your area is kind of looking for. That's a good start. Now, I will warn you, some of the more simple investors don't even get into cap rate, and that's okay. They just look at cash flow. So I will tell you, in my area, a cap rate of somewhere between 4 and 5%, and it will vary on a high quality real estate asset, is reasonable, right? So something that's been renovated doesn't really need anything. That's going to be in the 4 to 5 range. And then the market has little fluctuations. Larger real estate tends to have a slightly higher cap rate. Like those bigger apartment buildings, they're going to usually be probably closer into the 6 range. But for individual homes, because they're easier to buy, there tends to be a little bit more demand for them in a way, because there's more buyers that can actually buy that. So they tend to yield a slightly lower return for the person buying, right? The lower the cap rate is essentially a lower return for the person buying, because it's just a rate of return, right? So you as a seller, you want the cap rate as low as you can get it within reason, right? Because that gets you more money. And then the buyer, of course, wants the cap rate as high as they can get it, because that's just a higher return for them. So not to confuse the issue, it's okay if you don't get this stuff all right now. This is just an introduction, intro episode. We're going to talk about this stuff, many, many times, and hopefully I'll do many shorter podcasts to keep it concise and to the point, and then we can build on it. So once you understand how that all works, then it's time to continue on and start seeing some properties. Get a feel for what your renos are going to cost you. So you go into a property, you know what your finished product should be like. So you should know what things are renting for, what they need to look like. And then you go into the houses that are for sale and you say, hey, what would it take to get there? And this is a whole episode on its own, how to find contractors, how to do, how to estimate those costs. And we're going to dig in. We're going to have guests on this show that are going to help take you through it and help you to understand how that works. And it's going to be fun. I'm going to share all kinds of my thoughts throughout this process, and really just kind of try and engage you guys. If you have questions, send them to me. I'm not going to lie, I'm still figuring things out. I don't even know how to do a podcast yet. This is just the first episode. You'll wonder how I have this gear. It's because I'm a musician. You know, for those of you watching the video, you can see my jam room / our extra bedroom in the background here. So you understand the market, and you know what you're getting into. You understand what your rental costs are. And then the next step is to renovate. You rent it out. And renting it out, you can post on Craigslist, Kijiji, whatever. I recommend pay the money for the upgraded ad, pay to be top ad, and then make sure your pictures wow. If it's your first one, you might have to finish before you actually rent it. If you've done it a few times, you can take pictures from your old property to market your new property. And then you just take them through while you're renovating it, and they rent. I've rented stuff that really was in no condition to be rented when I rented it, but by the time they moved in, it was okay. So you start to streamline, and that's a great time to approach the bank too. Approach the bank while you're renovating. Get the approval conditional on them seeing the final appraisal. And this is what I would do. I would get them to come out. They would evaluate what I was doing, and then they would say, okay, once you're all done, renos, we just need to come out and confirm that you're done. And at that point, they would be ready to close the mortgage. And here's where you've got a little bit of a variable, because a lot of places are different, but here in Southwestern Ontario and Canada in general, when somebody does a appraisal, when they order it, it's usually random. So the bank just uses a third party that randomly will assign an appraiser to a project or to a house, and they come out and appraise it. This is where it pays to do some networking, because there is a large variance with appraisers out there. Some appraisers are great, some appraisers are kind of new, and some appraisers just don't understand investment properties, haven't seen them, haven't dealt with them, and you could see a variance. You could have two appraisers appraise the same property and be $200,000 off. I've seen stuff like that, maybe not to that extreme, but I know it happens. So that's one of those things where you're really going to want to know your mortgage person. And here's how I would recommend picking that mortgage person. Go out and find somebody that's doing what you're doing. Find out who they financed with and start making calls, start inquiring with as many people as you can until you find out who they got that finance with. That is the best way. Find somebody who did it. There's way too many guys out there that'll tell you they can. You want to work with somebody who did. That's absolutely number one. So I know that might seem obvious or overly simplified. I'm not trying to insult anyone here, but I've beaten my head against the wall trying to work with people who claimed they knew or could do and couldn't. So my biggest takeaway with that would be make sure that you do your research. This is hard work, guys. The initial part is hard work. This whole BRRRR method is hard work initially, but it can definitely be done, and the rewards are ridiculous. If you figure, if you're that 20% into something, that 20%, that $20,000 on the $100,000 house, and you're getting 30% on that, that's $6,000 a year on your money. How many times do you have to do that before you replace your income? And even cooler is, so say you do a buy, renovate, refinance, and repeat. What happens if you can actually pull out all the money you have in? So we just talked about a traditional method where you leave the 20 grand in. What happens if you could pull that 20 grand right out? Now all of a sudden you have a property for free. I mean, you have your work into it, but for money purposes, you have nothing into it. Now your ability to continue on is exponential. And before you know it, if you were hustling, in 1 year, you could probably have replaced your job's income. And this is where it gets a little strange, because, why aren't absolutely everybody doing this? Well, I can tell you there's many hiccups along the road. It's not super smooth, but it definitely works. And what you have to do is you have to be willing to persevere. And the only way you're going to be willing to persevere is if you're absolutely convicted in what you're doing and you know clearly why you're doing it. Otherwise, you'll slow down. And hey, everybody has blips. I've had many, where I've kind of lost track and lost focus. You can always come back, but it's really just going to dictate how fast you go. We're talking about knowing your appraisers. So you start with the bank that you're going to work with, because they order the appraisal. And once you know the bank, then you can start to figure out what their process is for picking an appraiser. Hey, how do you guys do this? What I've noticed is some way or another, some banks, some guys that work in banks, not going to name any names, have a way of sort of getting the appraiser they want to pick it up. And what that does is you can get an appraiser. So I deal in a lot of private sales. Therefore, there are no comparables on the market. And the only way to have for an appraiser to have a comparable for your property is if it's either on the market or they appraise the property themselves. So ideally, if you can work with somebody who appraises a lot of the type of property you're doing, you're going to get a more favorable appraisal because they understand the value and they can speak to it. So I can't stress that enough, that that's really important. You're not always going to have the ability to, maybe nudge an appraisal towards a certain appraiser. Sometimes it can happen. I'm really not completely sure how people pull this off when they do it, but it's definitely worth trying to look into if you can. Speak with your mortgage person. If they're competent at getting these deals done, odds are they've got an angle somehow. And that's just being opportunistic, guys. There's nothing wrong with trying to work the system the best you can on that. Obviously, you got to work within what the bank will allow for, but it's definitely in your interest, and it's really in everyone's interest to make sure that the appraiser appraising your property does truly understand the market value of it. The other thing that I would say is, your mortgage person, they've got a track record. They're proven. They've done it many times. Ultimately, you can probably leave it in their hands. What I've also seen with appraisers is sometimes if it's a certain neighborhood and they see, most things in that neighborhood are going in the 200 to 400 range, and then all of a sudden a $600,000 or a $700,000 pops up, a lot of appraisers just aren't even interested in taking that on. Because there's a certain obligation with appraisers. They don't want to underappraise something and get, yelled at by a client. They don't want to overappraise it and get in trouble with the bank. So if they're not confident, a lot of times they just won't pick it up. So from my understanding of it is basically when you put the appraisal request out, the bank puts the appraisal request out, it goes into a pool and there's a suggested value on that pool, and appraisers get to look at it. They can log in, they look at it, and they get to choose which ones they want to do. So if they see one that doesn't make sense to them or they don't feel totally competent in, I've noticed a good trend is that they don't tend to pick those up. So your standard home appraisal, any appraiser is going to pick it up. But those properties where you've gone into a neighborhood and you've added significant value and now it's worth quite a bit more than the rest of the stuff in the neighborhood, the nice thing is a lot of the appraisers out there won't actually dig into it. So you'll save it for the ones that do know, the ones that do those type of appraisals, and then it works out better for everybody. So once you're all done, the appraisal portion, the bank comes back with a value. They tell you what your value was. They tell you what they're going to give you. Usually around here, it's 80% of your finished value. So say you started at 100 and then you did some renos and you improved the property. And now, so you say you put in 20 and somehow you pull off some magic and it's worth 150. So if you're getting now 80% of 150, you can get the 80,000, of course, that you already have, plus another 80% on 50,000 more. So that's an extra $40,000. So now you're getting a new mortgage for 80%. So let's just do that math real quick. So $150,000 times 0.8%. So you're getting 120 less your existing mortgage of 80,000, and there's going to be some other fees in there, but let's just keep it simple. So that's a $40,000 net pullout from your property. Now you would have paid for your renovations, so you're going to subtract off what your renovations cost. So that leaves you with $20,000. So there's an actual scenario where you can actually pocket cash on a property that you didn't sell. So the property paid you to keep it. Now that to me is like the gold standard of what we're trying to do here when we're talking about the BRRRR method. And that's basically what I would strive to do at any time. For a lot of people, it's slow progress. It's slow, like, you're trying to renovate these properties. You're going to hit hiccups. Initially, it's going to start a little slow. But even if you could do one a year, if you're working a job and you just do one a year and you slowly work towards being in a position where you have so much cash flow coming from your properties that you can actually just quit your job. That's a pretty amazing idea. And I think that it's one that a lot of Canadians and Americans alike need to think about. I see a lot of people out there flipping properties. and it's so short-sighted. Why flip? Honestly, you're doing all that work for a quick little payout, but then you're going to have to drive by that property and realize how much money you could have made if you just hung on to it. And that's my thought with why BRRRR, why buy, renovate, rent, refinance, repeat. Why do that? It doesn't always work perfect, but it is probably the best investment strategy I think I've ever heard of, because you're not really investing cash. There's so many people starting from nothing. There's so many people that are just starting and they have absolutely zero. All you got is willpower. This is one of those things where you can start on a small place, and then as you get better and better, smarter and smarter, you get more connections. You can actually start to really improve your network, and you can really start to do more. For instance, you can do more. Maybe you can start pulling off 2 a year, 3 a year. Depends on how much energy you want to put into it. So it's totally fine if you're working a job and doing that. It's going to take work, but it's definitely worth it. And I'm sure I'll get into some of these stories here, but I mean, back when I was getting started, I actually slept in the properties I was renovating. And I don't regret doing that because it was all part of the process. And it was just a level of commitment I had at the time. So it's a good story too. That sort of wraps it up for the BRRRR method. I mean, we're going to talk about this again. We're going to have guests on, case studies. I've done it many times. I could do some case studies, but it's not all going to be about me. We're going to share ideas on this show. It's going to be a really awesome opportunity. So for my Canadian listeners, it's going to be, something a little unique because there's not really that many Canadian takes on this. For my American friends, there is pretty much everything I'm going to tell you is almost easier to do where you are. The only things that are a little different is our markets. There's way more disparity in your markets. Your good markets are really good. Your bad markets are really bad. And there might be a little bit of less of the in-between. But these principles work across the board. And no matter where you are, there should be a way to do this as long as you're in a free democratic country. For those checking this out, if you found me on iTunes, please take a moment to rate this podcast. Give me some constructive feedback or just really good feedback, even preferred. Please give me 5 stars, even if you're giving constructive feedback. I would greatly appreciate it, and I promise I will do my best to continue to improve this and continue to make it better. So I'm going to be looking to add in some special giveaways, give away one of my spreadsheets that I use to value properties, things like that, things that can bring some value. So I'm just going to find a way to set this all up. And then once I get it up and running, I'll certainly be letting you guys know how you can get more information. So until next time, thank you very much for watching the Andrew Hines Audio Real Estate Podcast. See you on the next one.